Hello, everyone, and welcome to BFW 2401. This is week 12, and we are recording for bank regulations. So this to the learning objective. We hope by the end of this lecture to be able to discuss the regulatory environment in which Australian banks operates. Now, we are talking about Australian banks, but you can always relate to the any country's bank. We can talk about Malaysian banks or your own country like Malaysia, like Indonesia, Sri Lanka, Japan, Korea, whatever. All those countries, they have the same setting with some differences. But what the data we are bringing here and the information is mainly related to the Australian banking. Now, we will talk about the outlining, outline the licensing. We will discuss the method used to ensure bank comply with the regulator's requirement, what we call the compliance system. In Australia, they have a system called BEARS and SOARS. And this one is the identification system, and the other one is the response system, and I will explain it later on. Then we will move to the, to the standard, which you call it APS. APS stands for Australian Prudential Standards. In this country, we have DGS, which is directed guidelines. And then in some other countries, they will have the same type of standards. But in Australia, the difference is they are very transparent. So you can look at the standards as you look to the accounting standards. Now, we will discuss also end of this lecture. We'll talk about the the benefits and the advantages and the disadvantages of the deposit insurance. We have talked about deposit insurance many times. I will touch on it just a little bit. This is resources, and actually the resources is EPRA resources, or you can look at them, or Bank Negara. And if you are in EPRA in Australia, Bank Negara here, and if you are from any other country, of course, you can access your central bank. Your central bank will be rich in terms of regulations. Now, we will start to talk about the agenda, and our agenda is actually we want to see why we regulate banks. And I think we have discussed this so many times to protect the system, basically. And then the second part, we'll talk about the regulatory environment. And when we talk about regulatory environment, just assume this is the easiest thing to talk about it. Assume now a new country was established, or a new economic group like ASEAN decided to be fully economic group like the European Union. Then in this case, they will have what we call a regulatory environment. And the regulatory environment, there must be a legislation, and this legislation has to come from the legislators, parliament, or what either thing you call it. And then that legislation, they will bring you an act. And this act or law will name the body that is supposed to supervise. And then after that, this body who was supposed to supervise will issue prudential, start in the process of supervising banks. So they will issue something called APS, which is the standards. And then everybody has to comply with those standards. And if you don't comply, there will be something like enforcement. This is the whole thing that we want to talk about it. And I want you to imagine it when you do the pre-class activity. You imagine it from this perspective, how we are going to do it. Because in each country, you have to go through all of those things. You have an act, you have a body, you have standards, and you have compliance, and you have an enforcement. Now, why we regulate banks? First, to reduce systemic risk, which means the risk as coming from huge banks and huge corporations. But in this case, we are talking about banks. So that systemic risk has to be prevented, and this to prevent the panic and the bank run. And then that will help the system to, contribute to the efficient flow of funds and support the confidence in the system. Then we have to protect the customers, which is also another issue. In this country, we have some regulations to protect the customers, like the depositors and the investors, and also ensure that deposits are safe and clients are treated fairly. And one most important thing which banks do is they use, for example, the benefits of the regulation, and they take more risk, which we call it moral hazard. Now, moral hazard has to be, taken care of, and the regulators have to, be sure that to minimize any moral hazard, which is the misuse of any regulations. Now, bank run we have talked about before, and I think when we talked about liquidity, a moral hazard is, as I told you, the use of, for example, when they use deposit insurance in the wrong way by assuming more risk since they are insured. Now, banking also regulation has been developed. In the past, it was for pricing and naming interest rates and all these issues. But after the 70s, and when the Basel regulations came and all those issues, we started to talk about regulation of bank capital. Now the regulators' focus is in bank capital. But if you look to for example, the Campbell report or the Wallace report, all of those actually were talking about something different from what we see today. Now, again, this is, as I told you, the government intervention in Australian banks are actually, I was talking about also Malaysian banks, you can look at it, but it is a bank legislation, regulatory bodies, prudential standards, compliance, and enforcement. Now, this is a process in any country. Now, let's talk about the Australia. Now, Australia, we will start to talk about, remember, we have a legislation, and this legislation was actually before it was the Reserve Bank of Australia, which was established in 1959, the one who was actually responsible about bank supervision. But then they started this APRA, which is Australian Prudential Regulation Authority, and in 1998, and this regulation, this actually party is the one who is the supervisor and who is the regulatory body. Now, APRA is doing the standards, APRA is supervising the banks, APRA is taking or receiving the reports, and APRA is actually financed, not by the government, but by the institution. I think 0.3% of the total assets has to be contributed from the banks for each bank in the country to APRA. And the Malaysia, I think Indonesia and some other countries, the regulators is financed by the government. In Australia, for example, you have APRA has so many powers. They license and they can withdraw the license. They license and they can withdraw the license. They will tell you what local banks can do and what foreign banks can do. One of the things we could notice here is the foreign banks is only, if you are incorporated out of Australia and operating in Australia, you can only receive up to 250,000. As you know, in this country, we have a lot of banks, which is foreign banks, and also we have foreign banks that is incorporated here. Now, this is different. If it is incorporated here, it becomes like a Malaysian bank with foreign ownership. Let me come to here why we, and we have talked about this so many times. So we actually weight the capital with the regulation. Now, we did that when we talked about the private incentives. And I think you have seen this formula before, and you have this saying, you have seen all this balance before, which means there is here risks and the risk has to be decreased by all of those issues, and then the capital is here. Now, the regulation is actually within this context. So they have to give so many regulation here to control credit risk, market risk, liquidity risk, all of those actually in Australia, also in this country, and so many other countries are regulated. And those regulation actually, which we call it APS in Australia, Australian Prudential Standards, is we have for credit risk, market risk, all those issues, as I will show you. And if you want to see, for example, credit risk, we have ABS 220, large exposures 221, liquidity 210, associated with banks 222, and then all those issues with the capital 120. I will explain them in details now. I think in week 11, we talked, and we will talk actually, since we covered actually the capital. And we talked about the capital adequacy, we talked about the measurements, we had talked about standardized model and non-standardized model, we talked about advanced models, we talked about measurement approach to operational risk. At least this is what you will, as we have talking in the recording. And therefore, if you look at Australia, ABS 110 to 117 is covering the capital. Now let's see what covers the other issues. We have ABS 231 talk about outsourcing, which means if the bank want to outsource some other body or company or party to perform for them any banking services, then this has to be operated under 231. They want to guarantee that the business is continuing with the bank. We have ABS 232, 240 talking about the risk management of credit card, one separate individual standard. ABS 310 is talking about the auditors, how they audit, what report they should have, and what type of audit. This is the external auditors who audit those financial institutions, and what type of information they should, send to the regulator. Governance, we have 510, fit and proper. This is a very important issue, which means who is going to be in the board of the bank. He has to be fit for that job. And so persons who are responsible for management and oversight, EDIs need to have appropriate skills, experience, knowledge, and act with honesty and integrity. Now, all of those as actually in the standard. So you cannot bring anybody and put them in the board, which is the top, authority in a bank. Now, ABS 210 talking about prudential requirements for providers of purchase payment facilities. We have those, when we talk purchase payment facilities, some people, for example, here in Malaysia, we have MEPS, which is Malaysian electronic payment system. This is a provider. Now, those providers, of course, are licensed by the government, by the Bank Negara. But in Australia, anybody who is going to do any payment facilities has to be applied with ABS 610. Now, the most interesting thing, or one of the most interesting thing, is the ABS 220. 220 is the credit risk. And in the credit risk, we want banks, the regulator want to decrease credit risk as much as they can and control this. So they say you have to have a level of risk depends on, this is how they see it, and the credit quality and the level of diversification. And they want to ensure that there is credit quality when we talk about individual loans, and there is proper diversification also. Now, if this is not really not in place, then you have a problem with credit risk. Also, they must have a management system for the credit risk. We have seen so many banks that they have to have a sounding system for the credit risk. They have to have a security evaluation policy for those assets they acquire and they keep. So especially for trading, they have to always evaluate them. So they have to use net market value where possible, and they have to have approved system for setting provisions, which means if you are going to have a provision, you can play with that provision all the time. But in Australia, and according to the standards, as well as in other countries, but we know ABS 220 will tell you how to set those standards, because if you have the right to increase and decrease the standards without any supervisory involvement then or regulation, then you can play with that and play with the bottom line. Now, we have also ABS 220. 221 is large exposure, which means if you are going to give a loan, that loan has to be, it's like when we talked about the concentration risk, how much a single loan should be. So they define in Australia, a big loan is any loan that is up to 10% of your capital. Now, you have to have effective policy by exposure limits, which means you have to see that 10% is actually the maximum you can expose in a single loan. ADI must have an effective policy for managing large exposures and risk concentration, including policies in exposure limits. They have to have prudential limits to large exposures. You can go up to 25% of your capital, but it has, and you can go to unrelated EDIs up to 50%, or foreign parent and subsidiaries up to 50% of your capital as loans. That is also expected. But when you do that, then you have to have approval from EPRA. So consultation with EPRA for any exposure up to the 25%. Now remember, when we talk about EBS 20 or EBS 2021, which is the large exposure, then actually it's related to credit risk. Now let me come to the another interesting issue, which is the liquidity. Liquidity, EBS 10, and I will summarize it here. I will not go through all of those things, but in Australia, they say, if you have a very good system for liquidity, and you can control that liquidity, and you can prove it to the regulators, you don't have to have a liquidity buffer, which means you don't have to have a percentage of liquidity. But if you don't have that one, you have to have a 9% in Australia. If you are small banks and you don't have the expertise to show that you are actually able to manage your purchase liquidity, your stored liquidity, and you're fully planning for liquidity, then just keep 9% as a buffer of your total assets. We have also the associated, but this is an important issue. See, the problem is with banks, they have some subsidiaries and they have associates, which means you will find a bank who buy an insurance company. You will find a bank who is, overtaking a provider of payments system. You have, and the impression with the people who are dealing with the banks is that, oh, this is owned by Public Bank or Maybank or Australian National Bank. So this is a bank. So the trust that comes to there is actually, it makes a problem because people think, well, this is a part of the bank. It's a different identity. It is associated, maybe some other partners with the bank on it. Maybe the bank is holding the majority of it, but they don't own it. And this is one issue, they don't own it. And then they are not responsible about their failures. So if they fail, or if they have any problems with the people they deal with, then it is independent identity according to the law. The other thing is how much loans you should give to them. If you are going to give loans to your associates, you have to do it in arm's length. And when arm's length, which means you have to deal with them independently, and the loans they have to have is actually should be fully independent, which means it's an arm's length. That means as you are going to give a loan for any other party, there is no preferences, there is no advantages of being associates to get more loans or better conditions. It should be independently as you are another customer. Must have for the financial exposure, you must keep EBRA regulatory informed if you have any financial exposure with your associates. And if there is no financial exposure, it has to be 5% of your Tier 1 capital. Now, you have always to eliminate this impression, which is this associate belongs to the bank. It doesn't belong to the bank. We have also 120. 120 is actually related to management and securitization. It had to be clear that when banks issue and have a special purpose vehicle and they sell the loans, that they are not, it must be clear that they are not responsible about it, unless it's, you know, exceptional saying that the bank still, because people start to buy those securities by a special purpose vehicle and they think it's the bank. No, it's not the bank. It is this, you know, special purpose vehicle who now buy the loans and starting to sell them. Bank level obligation must be clearly defined when they run what we call funds for others, or when they have this securitization issue. Now let me come to the compliance. Compliance is, there is a compliance cost. When you compliance means you have to carry out and you have to you know, apply the standards. And that is actually costly. Why? Because you have staff and administration services to do all of this, to develop and monitor systems, to comply. You have the cost of, you know, the implementation, and you have to ensure compliance with EBRA's requirements. Collect information and statistics. You know, they can send it in monthly sometimes basis, and they can send it, but of course they send it in quarterly basis. You have too much risk. If EBRA believes that the bank is taking too much risk, it will instruct the bank to improve risk management system and procedures. Bank normally follow EBRA's instructions or any other regulator, but if they don't, there will be a problem. If the bank does not compliant, there will be an issues, and that issues can be lead to EBRA will take over the bank and wind it up. Now, also in the compliance, you have to send audits. You have to audit it. You have to send reports and statistics. This is one of the information that you have to send to EBRA. EBRA also want the external auditor reports to them. So they want to see things are okay. And also EBRA will send their team to check. As you can see now, all of those actually part of information that EBRA receives. So it's very, for the EBRA, they know, or for the regulator, they know what's going on because they receive all those type of reports. Now, there is a legal responsibility for the CEOs. When you take over a CEO in a bank, then you have to undertake statements saying that the risks have been identified, the risk management system are in place, and the risk management system is also working. Let me come to the last point, which is the most important thing, which is the compliance. Now, the compliance in Australia is very, so now we already talked about the standards. We talked about the compliance. This is how we check the compliance. So to make it clear that we come from the basic formula, which means you have a risk, all those type of risks, and you have management to control, and then you have a capital, and then whatever after that, you know, it has to go to the capital. Depending on this argument, in Australia, they developed what you call indexes, which they will check your risk based on your size, and they will develop 4 indexes. One called index for probability of failure, which is between 1 and 256. And the other thing is index for impact, which means how big you are, because a bigger bank, collapse of a bigger bank is you know, harder than for the economy is harder than a smaller bank. And then they have the follow the CAI, which is the Supervisory Attention Index, and they expect this to be 4, which is the underscore root of probability of index and impact. Now, for the index of impact, bank total assets, if it is 50 million, as I said, I told you, for the probability index, 1 to 56. For the size, which is the index for impact, if you are less than 50 million, you have to use this 0.25. Other than that, you have to bring the assets in millions and divide it by 200. Let me give you this example. For example, you have an index of probability 256. So the bank total assets is 50, 25. You have to give 25. If it is more than 50, you have to have assets over 200. There is, I think, an example here, which is this one. Look, if you have ABC Bank, probability of index is 10, which is out of the 256. This is not really a risky bank. Total assets 320. Then you have to calculate the impact of index 320 over 200, 1.6. And then you have to calculate the attention index, which is the underscore root of 10 times 1.6. So it's 4, and 4 is accepted. They expect every bank to achieve, a mark of or a score less than 4, not to be risky. Now, let me take you actually to the last point. Now, this is what we call the pairs and the source. And this is identification system, and this is the source system. So from the identification system, they will take all this information, and they will bring the risk, which is this here, from 1 to 256. And this is the size of the bank. Extreme, high, medium, low. Now, if it is low and extreme and low, which means the risk is low, the action that should apply to this bank is normal. This is identification system where you stay. Now, who decides how much is extreme, how much is high, how much is medium, how much is low in terms of the size of the bank? EBRA does that. Will tell you this is an extreme size, this is small, high size, medium size, or low size. But this from 1 to 56, we already know that one. And who decide how much scores from the 256 is low, how much low medium, how much high medium, high. I know all of this line is 200, everyone is from 1 to 256. EBRA will also decide on this one, and then they will vote. Maybe you are this bank who have low medium and you are high, then the policy is oversight. The question is, what is oversize means? Oversize means, see, you have normal, this is the source. This is the pairs, this is the source. So the source will tell you if it is oversized. This is identity, this is identification of it. Identity is not expected to fail, but there is some concern. So what to do? Very transparent, more frequent prudential review and collection of data, communication with auditors, request or revise business plans, expressing concerns, and you can continue like this. For example, if somebody is really high, extreme, and here extreme, restructure. See, if you are very big size and your risk is high, they stop you immediately. So this is what we call the structure. So EBRA has lost confidence in the bank, and then they will, they will withdraw the license and do all of those issues to stop the bank from damaging the system. So this is actually the process between the source and the pair system, and this is a very excellent system for the compliance, because now you have to, it is compliance and it is also enforcement. So this is the action of enforcement. So now, just to take you back, we have body, we have legislation, we have body, we have standards, and after the standards, we have compliance, and the fifth one, we have the enforcement. We have now full picture about how this regulation works, and it actually applies to all those countries. Now, I am done with this. Actually, this is just repeating. I will go to deposit insurance, and they don't want to go to deposit insurance too much. It's just this deposit insurance has been there for a long time. I think we have a pre-class activity for this deposit insurance, pre-class activity number 3. And deposit insurance is have advantages and disadvantages. And there is also a body, which is FCS, Financial Claims Scheme, is the one who it operates under this one. And in Australia, also like Malaysia, but in Australia, they guarantee up to 250,000, and they keep updating all these things. If you are business, I think 1 million as a minimum balance, and therefore they are guaranteeing the system. This is, you can read about actually deposit insurance, the rest of it, and which we have talked about. I think I am done with this. Thank you very much. I will stop sharing. And I wish you can use this as part of your sources for pre-class activity. And it's actually helpful in your understanding the regulation. Thank you very much and have a very great week. Bye-bye.